Let's jump right into it. Welcome to The Explainer. I am so thrilled you're here today because we are breaking down a massive tectonic shift in the financial world. We're going to explore how Vanguard didn't just, launch a new investment product, but fundamentally rewired the underlying economics of the entire asset management industry. Really, this is a story about how structurally low costs became an absolutely unstoppable economic weapon. Okay, let's dive into this. Consider these two numbers for a second. As of December 2025, Vanguard's average mutual fund and ETF expense ratio was a microscopic 0.07%, while the broader industry average stood at 0.44%. Now, you might look at that and think it's just a friendly discount or a temporary sale, but it's not. As we're going to see, this stark contrast is literally an aggressive economic weapon that entirely changed the battlefield for active fund managers. To really grasp Vanguard's true market impact, we're going to use this framework today to follow the systemic chain of events. We'll start with the fast intuition, move to Bogle's original Heresy, look at the investor-owned engine, map out the Vanguard Flywheel, hit on the Arithmetic warning, and finally explore the post-Vanguard world. So kicking things off with Section 1, the fast intuition, where the default question was changed forever. Think about the industry before Vanguard. The only question anyone was asking was, which manager can beat the market? It was entirely about finding that one superstar stock picker. But Vanguard flipped the script. They changed the default question to, why should I pay high fees for the chance to actually underperform a really cheap alternative? And here's the genius part. Vanguard didn't even need to prove that all active managers were bad. They just needed to make the high-fee active fund justify its very existence. That brings us to Section 2, Jack Bogle's original Heresy and the pure arithmetic of the market. And this brilliantly illustrates Bogle's core heresy. Do not try to find the needle, buy the haystack. He realized something profound, yet mathematically incredibly simple. Before costs are factored in, all investors collectively earn the market return because they literally are the market. Therefore, once you deduct costs, the average investor absolutely has to lag the market. It is just pure arithmetic. So instead of paying expensive teams to dig around looking for that one needle in the haystack, Bogle's radical proposition was simply to buy the entire haystack. So what is Vanguard, really? It's easy to think of them as just a mutual fund sponsor or a ticker symbol, but it's much more than that. It is an investor-owned investment platform built from the ground up to deliver broad market exposure at a structurally low cost. That very first index fund wasn't just a product. It was an institutional answer to a massive philosophical problem. It systematically replaced all that glamour and mystique of Wall Street stock picking with rigorous, cost-controlled discipline. Which leads us to Section 3, the investor-owned engine, and their absolute structural advantage. Let's compare these two models. A typical publicly traded asset manager is constantly trying to balance client outcomes with their own profit margins, paying dividends and generating returns for their shareholders. It's a tug of war. But Vanguard is actually owned by its funds, and those funds are owned by the investors. They don't have external shareholders breathing down their necks to extract a wider profit margin. So when they gain scale and lower their operating costs, they aren't using that to boost a stock price. They literally return those benefits directly to you, the investor, by lowering fees. They get to frame fee cuts as fulfilling their mission. And let me tell you, in a price war, that is a massive structural advantage. Let's look at exactly how that plays out in Section 4, the Vanguard Flywheel and the momentum of scale. I want you to just take a second to really absorb this sequence. Just let this process sink in. This is basically a fee compression machine. First, they offer low-cost exposure. Because it's cheap and it works, it attracts assets. As those assets swell, all their fixed costs, like technology and administration, are spread over a massively larger base. That efficiency lets them jump to step 4 and actively cut fees again. Suddenly, every single competitor out there looks drastically more expensive by comparison. What happens next? They gather even more assets, and the flywheel just spins faster. It's a compounding loop of scale that traditional distribution models simply could not defend against. Now for Section 5, the arithmetic warning, or the harsh reality of reverse compounding. So the crucial point is this. Imagine Fund A charges 0.05% in fees, and Fund B charges 1.00%. Notice that critical warning there. Before a single trade is even executed, Fund B starts almost a full percentage point behind every single year. That active manager has to generate a full percent of pure alpha just to break even with the cheap index fund. And here's the reality. Investment performance is highly uncertain, but those fees, those are absolutely certain. Over a 20 or 30-year horizon, this reverse compounding creates a hurdle that is almost entirely insurmountable. And this isn't just some academic economic theory. Let's look at the actual data from the ICI. Back in 1996, the average equity mutual fund expense ratio was 1.04%. Fast forward to 2025, and that number had plummeted down to 0.40%. Vanguard's pricing gravity literally forced the entire industry's revenues to compress. Competitors had absolutely no choice. They had to slash their fees just to stay in the game, which caused the traditional revenue pool for the whole industry to shrink significantly. And the ultimate result of all that fee compression, well, by February 2026, U.S. long-term index funds and ETFs held $20.06 trillion, officially overtaking the $18.01 trillion held by active funds. Passive investing didn't just win a small victory here. It literally became the default infrastructure of the saving system, capturing the absolute majority of long-term assets. Now, if you're wondering why investors made that massive shift in the first place, here is the ultimate consequence. According to the 2025 SPIVA report, a staggering 79% of active large-cap U.S. equity funds actually underperformed the S&P 500. When you combine those high fees we talked about with a super high probability of underperforming the benchmark, generic active funds just lose their core mass market defense entirely. Which brings us to our final section, Part 6, the post-Vanguard world, and how active management adapts to survive. Now, what's really interesting about this slide is understanding exactly how the old model broke. Vanguard effectively triggered multiple channels of destruction all at once. The sheer revenue compression starved out the mediocre funds. At the same time, fiduciaries and advisors were under intense pressure to justify every single dollar they spent on fees. Then, benchmarking became hyper-transparent. You could see the cheap index funds sitting right next to the active fund on your platform. And finally, closet indexing, which is where active funds secretly just hug the index to avoid lagging too far behind, was brutally exposed. I mean, why pay active fees for what is basically a passive portfolio? But let's be absolutely clear about something. Vanguard didn't eliminate active management entirely. Active is not dead. What died was the generic, overpriced, mass market mutual fund. Today, to survive, active management has to be highly specialized. It has to live in active ETFs, it has to be incredibly tax-aware, or it needs to focus on less efficient, complex areas. Think private markets, small caps, or specialized credit, areas where deep research and true skill actually make a measurable difference. Which leaves us with one massive, lingering question to end our explainer today. If Vanguard's low-cost flywheel continues to pull in trillions of dollars, and passive investing completely dominates as the default infrastructure, what ultimately happens to market price discovery? Seriously, if everyone is simply buying the haystack, who exactly is left to price the needle? It is a structural risk the entire financial world is watching incredibly closely. Thank you so much for joining me on this deep dive, and I will see you in the next explainer.